Today, we are diving headfirst into one of the most incredible financial train wrecks of the 20th century. It's a story packed with mind-boggling brilliance and an even more mind-boggling level of arrogance.
Welcome back. In today's Explainer, we are digging into the fantastic book by Roger Lowenstein, When Genius Failed. It's not just a story about numbers, it's a deep dive into the human flaws and the intellectual blind spots that made a global financial meltdown almost inevitable.
So the fund at the center of this whole storm was called long-term capital management, or LTCM for short. And when I say they were run by smart people, I mean this was the financial equivalent of an all-star team. We're talking Wall Street legends and not one, but two Nobel Prize winners in economics. Which leads us to the billion-dollar question, right? If these guys were so incredibly brilliant, how on earth did they get it so catastrophically wrong that they literally brought the entire global financial system to its knees? Well, that's the mystery we're unpacking today. Now, to really get this story, we're not going to start at the beginning. No, we're jumping right into the end, with the explosion.
So, picture this. A private hedge fund had become so huge, so leveraged, and so toxic that the U.S. central bank, the Fed, had to step in. They literally forced the heads of Wall Street's biggest banks into a room to hammer out a multi-billion-dollar bailout, just to stop a chain reaction that could have frozen the world's economy. The stakes just could not have been higher.
So who were these architects of chaos? Let's meet the dream team and try to understand the so-called science they believed was absolutely infallible.
So, the guy in charge was John Meriwether, a legendary trader who was a master at finding quantitative talent. But the real star power, the academic muscle, came from Robert Merton and Myron Scholes. These guys had literally won the Nobel Prize for their groundbreaking work on how to price financial derivatives. So you see, this wasn't just another hedge fund, it was pitched as a scientific laboratory for finance.
Their whole strategy, at its core, was actually pretty simple to grasp. It was called convergence trading. They weren't betting on whether stocks would go up or down. Nope, they were betting on relationships. They'd find, say, two very similar bonds whose prices had drifted apart for some reason, and they'd place a massive bet that those prices would eventually snap back together, just like a rubber band.
And this perfectly captures their mindset. They truly believe that the messy, emotional, chaotic world of financial markets wasn't really chaotic at all. It was just a complex system that could be solved, like an engineering problem, if you just had enough brainpower and the right mathematical models. In their minds, they were scientists discovering the laws of finance, not gamblers rolling the dice.
And you know what? For a while, it looked like they had actually cracked the code. Their first few years were nothing short of spectacular.
I mean, just look at these numbers. They speak for themselves, right? The regular market was doing fine, but LTCM was playing in a completely different league. They were delivering these insane returns that made them the absolute envy of Wall Street. Banks were literally begging them, just begging to lend them more money.
But here's the secret sauce, which was also a ticking time bomb. Massive, extreme leverage. Because each of their trades only made a tiny sliver of profit, they had to use borrowed money to magnify those profits into something huge. At their peak, for every single dollar of their own money, they were controlling over $100 in assets. It's like driving a race car where the slightest touch of the steering wheel sends you flying across 3 lanes. That was their level of risk. The tiniest move against them could be absolutely catastrophic.
And this brings us right to the intellectual heart of the story, the fatal flaw that was baked into the very core of their genius from the very beginning.
You see, their models lived in a perfect, rational world that always followed the neat patterns of history. They actually calculated that a single day bad enough to wipe them out could only happen once in the entire lifetime of the universe. But the real world is driven by human beings, by fear and greed and irrational panic. And in a true crisis, all the old rules just go out the window. Everything starts moving together, and the impossible suddenly starts happening with terrifying regularity.
There's a quote from the book that just sums it all up perfectly. LTCM's partners became so obsessed, so mesmerized by their beautiful, elegant maps of the market that they completely forgot that the real-world territory is wild, it's unpredictable, and it's filled with dangers that no map could ever possibly show you.
And in the summer of 1998, they wandered right off that beautifully drawn map and straight into a perfect storm, a storm that their models insisted couldn't even exist.
The trigger was an event halfway around the world. Russia defaulted on its debt. It sent this massive shockwave through the global system.
All at once, investors everywhere panicked. They sold anything that seemed even remotely risky and piled into the safest things they could find, like U.S. Treasury bonds. And for LTCM, every single one of their trades blew up at the same time. The price gaps they were betting would close, they exploded wider. The impossible was now happening day after day after day.
I mean, the scale of the losses was just breathtaking. On one single day in August, the fund lost over $500 million. $500 million gone in a matter of hours. Their Nobel Prize winning models were just dissolving into dust right before their eyes.
And this was the final brutal trap. They couldn't just sell everything and cut their losses. Why? Because their positions were so enormous, so gigantic, that just trying to sell them would have crashed the markets all by itself, which would have only accelerated their own destruction. Their own size had become their prison.
And this leads us to the final act of this tragedy, the incredibly controversial rescue and the big question of whether Wall Street or any of us learned anything at all. With the entire global financial system teetering on the brink, the New York Fed finally stepped in. Now, it didn't use taxpayer money directly, but it basically twisted the arms of the major banks, many of whom were deeply exposed to LTCM anyway, to cough up almost $4 billion to prop the fund up and prevent a complete meltdown.
And this is where we have to talk about a critical idea called moral hazard. The bailout, whether intended or not, sent a crystal clear message to the financial world. If you get big enough and interconnected enough, you won't be allowed to fail. It meant that your profits are your own, but your catastrophic losses, well, those might get shouldered by everyone else.
And this really is the book's most chilling conclusion. The LTCM bailout wasn't just the end of one crisis. You could argue it was a dress rehearsal for the much, much larger financial crisis that was coming in 2008. It reinforced this dangerous idea that some firms were simply too big to fail.
Ultimately, the story of LTCM is this timeless, powerful warning about the deep, deep danger of intellectual arrogance and the folly of ever believing that human genius can truly tame the wild, unpredictable nature of the market. And it leaves us with one haunting question.